Seasons change. Winter into spring, basketball into baseball, and the winds have certainly changed direction this earnings season, giving us hope for a big 2021. That's where we start this week's edition of the Fastest Four in Finance. Hello again, I'm Scott Inman. Thanks for watching the Fastest 4 Minutes in Finance. Well, the big dance is over, and since I'm not a big NBA fan, that means basketball season's pretty much over for me, and it was certainly one I will always remember. The Razorbacks muscled their way to the Elite Eight for the first time since I was just out of college. My kids have never known what it was like to have the Razorbacks go that deep into the NCAA tournament, so it was certainly special to share that with them. And I will always remember the Gonzaga-UCLA game. It was an instant classic. But all seasons change. And for me, that means it's time for Cardinal baseball. It also means we are moving in to warmer weather. I count on those changes in seasons, even if I'm sad to see it happen. It's really a measurement of sorts for my life. Well, in the stock market, the measurement we watch most closely is not the day-to-day movement in the price of stocks, but its earnings. And it is once again earnings season. So now to those winds of change. Take a look at this chart. This is a look at the year-over-year earnings growth of corporations in the S&P 500 index over the past couple of years. It's easy to spot when the pandemic began. Earnings were down more than 30% in the second quarter of last year as economic shutdowns took hold across the country and Americans stopped their daily routines and lifestyles. But by the last quarter of 2020, earnings had turned positive, and that surprised analysts. Now into the estimate side of the chart there, the consensus estimate for the first quarter of 2021 ending March 31 is 24%. That's 6% higher than estimates released at the beginning of the quarter. And that's the biggest revision since FactSet began tracking earnings data in 2002. Higher estimates tend to signal companies will be able to deliver upside potential. And that has LPL Research thinking perhaps earnings growth may be even bigger than the already big estimates. So why is that? Well, it's important to note that these estimates are driven largely by the guidance being given by the companies themselves. An unusually high 64% of S&P 500 companies guided numbers higher during the first quarter. Earnings are important because we believe they are the fundamentals of the stock market. Day to day, the market can be volatile, often reacting to the news of the day. But we believe pricing in the market eventually returns to fundamentals. If companies are making money, investors want to hold that stock. Of course, as in any sports season, there are always upsets, and there could be actual news that does affect earnings. We are winning the battle against COVID-19, but there is always the risk of a setback. The unemployment rate is dropping, and that's a good thing, but that could put pressure on wages. And if wages go up, it could be a headwind for corporate profits, especially if that's coupled with an increase in corporate taxes, which of course is in the works in Washington. But those pressures wouldn't likely be realized until 2022. So the bottom line is American corporations have been much more resilient in the face of historic economic shutdowns than anyone thought. And 2021 could be one historic comeback, worthy of an instant classic. Thanks for watching.